You may be able to take over a seller's mortgage and keep their lower rate. That's what an assumable mortgage is. Let's cover who qualifies, how it actually works, the timeline, and when it can be a smart move. Hi, I'm Jeffrey Hoffmann, and I help buyers and sellers across the Hudson Valley region. So what loans are commonly assumable? Most FHA and VA loans can be assumable, and some USDA loans as well. Standard conventional loans usually aren't. Your lender and the current loan servicer will confirm the program and the rules. Who needs to qualify? The buyer needs to qualify with the servicer under today's guidelines. Income, debts, and credit all matter. The seller's loan terms carry over, but the new buyer still has to be approved. If it's a VA loan and the buyer isn't VA eligible, ask how the seller's entitlement is handled. Your lender and attorney will guide the specifics. Here's how the math works. You assume the seller's remaining balance at the seller's existing rate. If the purchase price is higher than that balance, there's a cash gap you have to cover with funds or secondary financing. Sometimes a seller credit or a negotiated price helps, but the gap is real and it should be on your worksheet. Timeline and paperwork. Assumptions add servicer steps. Expect an application, document requests, and a transfer process. Plan extra time compared with a standard loan. Put key dates in writing, including access for appraisal or any required inspections. Clear dates keep everyone aligned. The pros. If the seller's rate is meaningfully lower than today's rates, your monthly can drop without waiting for the market. The amortization clock keeps running where it left off, which can be a quiet advantage if the loan is already a few years old. Cons to keep in mind. You need to solve the cash gap between the price and balance. The servicer process can take longer. Some programs have occupancy rules. Read the actual language and get your questions answered before you commit. When it shines. An assumption can make strong sense when the existing rate is much lower, the remaining balance is large enough to matter, and you have a clean source for the gap. It can also help a seller stand out in a tight market by advertising an assumable loan and clear next steps. Here's how to evaluate one in 10 minutes. Use the 2-scenario worksheet and ask your lender for 2 printouts and a baseline. A standard new loan for the purchase price you're considering. B, an assumption printout at the seller's rate and balance with the cash gap listed. Baseline, the same price with no lever, so you have a clean comparison. Look at monthly and cash to close side by side, then add a quick hold period note. If you'll likely move in 7 years, ask how both options look at 7 years. A quick example. A listing had a 3.25% FHA loan with a $420,000 balance. The purchase price was $560,000. The buyer assumed the loan, brought $140,000 to cover the gap and costs, and locked in a monthly that was hundreds lower than a new loan at current rates. It took extra calendar time, but the math worked for their plan. If you want the template that makes your lender ask simple, download the 2-scenario worksheet and send it to your lender with your request for printouts. The link is below.